I believe that the in-depth review of tax returns, pay statements, and Social Security statements tell a story about the families we serve, discovering countless opportunities for deeper quantitative and qualitative discussions. So during this lesson, we are going to review one of my favorite documents, the Federal Income Tax Return, the Form 1040 with supporting schedules. Combining knowledge from the CFP and EA education programs, I've enjoyed connecting the dots between taxes and the dozens of other planning topic areas we cover as financial planners. Since every movement of money involves a tax consequence or specific exception, I don't think it's possible to provide comprehensive financial advice without intentional tax planning. Starting at the top of the Form 1040, we'll see the client's tax filing status. Although this appears as a simple election, it will affect deductions, credits, and tax rates along the way. Single and married filing jointly are fairly straightforward, based on their marital status at the end of the tax year, with the exception that a surviving widow or widower may claim married filing jointly in the year their spouse dies. If the surviving spouse doesn't remarry and cares for a dependent child moving forward, they may be able to file as qualifying widow, widower, but only for the 2 years following their spouse's death, then switching back to single or head of household. Lastly, married couples can choose married filing separately if they want to be responsible for their own respective taxes, or if filing this way results in less tax or other payments owed. I see this box most commonly checked when one spouse wants to qualify for lower income-based student loan repayment, although they may lose out on some other tax credits and deduction opportunities, including the education tax credits and student loan interest deduction. If filing separately, attempt to connect the dots, but also include this topic in future conversation. When reviewing the taxpayer and spouse's information, cross-verify the listed Social Security numbers against their respective Social Security statements for accuracy. Also take note of their home address listed here, which may clarify their primary residence if they own multiple properties. Whether a client's tax return has this virtual currency box checked or not, they may still own cryptocurrency. So ensure they share any of these accounts and assets with you, since most of them cannot be aggregated into the planning software. The next section will indicate whether they received additional standard deductions, being age 65 or older and or blind as of the last day of the year. If over age 65, you will immediately know to investigate Medicare and supplemental health plans. The dependents section will indicate if they provide more than half of the support for a child or relative, and whether they qualify for the child tax credit or credit for other dependents. Some state tax returns will also indicate the birth dates of the children, which is helpful for determining their age even before your follow-up meeting. If claiming the credit for other dependents, this will indicate a dependent age 17 or older. This section reminds us to have conversations about family health insurance coverage and the independence of their own parents and other relatives. Many of the families I've served are concerned about the potential financial burden if their parents require significant long-term care needs or need to live with them, and it's better to plan for these events when times are good and emotions are level. Moving on to the income section, all taxable wages received as an employee are on line 1. Keep in mind that pre-tax workplace retirement plan contributions, workplace HSA contributions, and group benefits premiums have already been excluded from taxable income on the Form W-2 and cannot be further deducted again on the tax return. So no double dipping. We'll see examples of this moving forward. Line 2A, 2B will tell us if they received non-taxable municipal or taxable interest income within taxable brokerage and bank accounts. If the taxable interest number exceeds $1,000, this may indicate a large cash, money market, CD, or other fixed income position within their non-retirement accounts for further investigation. If they receive municipal bond interest and file a state income tax return, the bond interest received from municipalities within their state may be incorrectly reported as taxable interest if their tax preparer doesn't go deep enough. When reviewing interest, we can also look at Schedule B to determine which institutions custody their accounts, to cross-verify, and find opportunities to clean up or consolidate. Line 3A, 3B helps us to determine if their taxable brokerage investments are tax optimized in terms of asset tax location. I divide the qualified dividends into the ordinary dividends to determine the percentage that is receiving favorable taxation at the capital gains tax rate, 0%, 15%, or 20%, plus the 3.8% net investment income tax if applicable. So in this example, $35,101 of the total $43,442 equals 81%, meaning most of the dividend distributions received within taxable brokerage accounts are receiving favorable tax treatment. If this number is much lower, this indicates they likely receive non-qualified dividend and interest distributions from mutual funds and other securities within taxable brokerage accounts. The culprits can be found when reviewing the account holdings or looking at the related Form 1099-DIV. Line 4A, 4B shows IRA distributions and conversions from Form 1099-R. This will include traditional IRAs, Roth IRAs, SEP IRAs, and simple IRAs. If the taxable amount is shown and lower than the total distribution amount like we see here, this indicates a rollover or pro rata distribution of cost basis versus earnings, which we'll investigate further on the Form 8606. If the IRA distribution was a rollover, the word rollover would be shown next to line 4B. And if the client was over age 70 and a half, take note of any qualified charitable distributions, also known as QCDs, to ensure they are reported correctly, since they're commonly missed by tax preparers. Here is Form 8606, which reports non-deductible traditional IRA contributions and their year-end cost basis, then any Roth conversions or distributions. Since this taxpayer converted portions of their traditional IRA to a Roth IRA, but still had pre-tax balances in their traditional IRAs by the end of the year, a portion of that conversion was included in taxable income. To avoid this taxable conversion, they may have had the opportunity to transfer the pre-tax IRA balances into a workplace retirement plan, then convert the remaining after-tax balance without any tax consequences, aka the backdoor Roth IRA conversion. Line 5A, 5B shows pension and annuity payments from Form 1099-R, which may include distributions from 401ks, 403bs, and 457b plans. Non-qualified annuities are also included here. An exclusion ratio of pre-tax versus after-tax payments applies if the taxable amount is lower than the total amount shown. And rollovers from qualified workplace retirement plans will also be shown here with the word rollover entered next to 5B. Line 6A, 6B shows the Social Security benefits paid from Form SSA 1099 in Box 3. Only up to 85% of the Social Security benefits will be included as a taxable amount based on what's called combined or provisional income. More information about the combined income formula and 0%, 50%, and 85% inclusion of Social Security benefits is linked below. Line 7 reports net realized capital gain or loss, including capital gain distributions from mutual funds within taxable brokerage accounts. Schedule D may also be attached with more information. Up to $3,000 of net capital loss is available to offset ordinary income, so you may see negative $3,000 in this line, with the remaining carried forward to offset future capital gains. Form 8949 will also show the detailed trading activity for more information. You can review Schedule D to see short-term and long-term capital gains and how they're netted against each other in more detail, ultimately flowing to line 7 for the net realized capital gain or loss. Line 8 directly flows from Part 1 of Schedule 1, Additional Income. On Part 1 of Schedule 1, Additional Income, you may commonly see alimony received from a pre-2019 divorce, business income or loss from Schedule C, which we'll review shortly, rental real estate and other business income from Schedule E, unemployment compensation, and less common forms of income seen below. Here is the Schedule C, used to report income and expenses for self-employed businesses. You can view their gross sales and gross income, then move down to review their various expenses. Their total expenses, including the possible home office deduction and net profit or loss, can provide additional insight into their primary or side business. So line 9 adds up the total income from that whole section before it's reduced by adjustments to income. Line 10 shows adjustments to income that flow from Part 2 of Schedule 1. These are commonly called above-the-line deductions since they are above the tax line of adjusted gross income, AGI. On Part 2 of Schedule 1, adjustments to income, you may commonly see the deduction of HSA contributions made separate from payroll, the deductible half of self-employment tax, self-employed retirement plan contributions, self-employed health insurance premiums, alimony paid from a pre-2019 divorce, deductible traditional IRA contributions, student loan interest, and various other less common adjustments. By reviewing Form 8889, which reports the HSA contributions and distributions, we can determine how much they contributed through their employer or outside of their employer. The portion they contribute through their employer also is excluded from Social Security and Medicare payroll taxes. If there are distributions from the HSA, we can have conversations about whether they'd like to use the HSA as a spending account or a savings account moving forward. And lastly, we can ensure that any taxpayer age 55 or older that's covered by the HSA eligible High Deductible Health Plan HDHP is contributing their catch-up contribution. If they're contributing to a family HSA and both spouses are over age 55, ensure that there are separate HSAs rather than just one, because they may be losing out on that additional catch-up contribution. So after total income has been reduced by these adjustments to income, we naturally arrive at adjusted gross income, commonly called AGI. This number is really important since it'll be the starting point to determine the impact of healthcare subsidies and Medicare surcharges, also called IRMA. Line 12A shows whether the taxpayer claimed the standard or itemized deductions. If higher than the standard deduction, we'll look at Schedule A to determine how they were able to itemize. On Schedule A, we can discover opportunities for conversations about previous and expected medical expenses of the family, property taxes and how they are earmarking those payments alongside homeowners insurance premiums, deductible mortgage interest and what's expected moving forward there, and gifts to charity. The tax return information may include an overflow statement showing all of the charities that they gave to, and you can learn more about the family's unique values and generosity through your follow-up conversations. Line 13 shows the Qualified Business Income QBI deduction from Form 8995, which may also include qualified REIT dividends received within taxable brokerage accounts. After adjusted gross income, AGI, is reduced by the standard or itemized deductions and the QBI deduction, we finally arrive at taxable income. This is the number referenced when calculating ordinary income tax and capital gain tax rates. To quickly estimate ordinary income tax liabilities, I keep this federal income tax rate chart next to my desk. It shows the marginal tax rate based on taxable income on the top chart, including the basic calculation for determining taxes owed. Keep in mind that this chart does not include considerations for capital gain taxes, tax credits, and additional taxes. And the chart on the bottom of this page helps to educate about the difference between marginal and effective tax rates. For example, a single filer will move into the 10% marginal tax bracket once their adjusted gross income, AGI, exceeds $12,950, which is the standard deduction for a single filer. Although taxable income within that marginal bracket will be taxed at 10%, that doesn't mean all of their income is taxed at 10%. A single filer will not exceed the 10% effective tax rate unless their AGI exceeds $60,266. Before determining whether someone should contribute to a traditional, pre-tax, or Roth after-tax retirement account, we need to consider the current marginal versus future effective tax rates, especially if they aren't anticipating other significant sources of taxable income such as pensions, rental income, etc. Here is another useful chart I use to look at the difference between effective and marginal tax rates based on AGI and the standard deductions for the single filer and a married couple filing jointly under age 65. For example, a couple married filing jointly have AGI of $105,000, taking out the standard deduction of $25,900, it comes down to a taxable income of $79,100. Taxes owed on that using the basic calculation is about $9,000. So they're in the marginal bracket of 12%, but their effective tax rate is closer to 8.5%. After the tentative tax has been calculated on line 16, credits are subtracted and additional taxes may be added, which may include excess advanced premium tax credits, which are overpaid healthcare marketplace subsidies, alternative minimum tax, child tax credits and credits for other dependents, education credits, self-employment tax, additional Medicare tax and net investment income tax, and additional tax, often called tax penalties, for non-qualified distributions from retirement accounts and HSAs. Each one of these will provide valuable information about the family's unique financial situation and creative planning opportunities that you can help them with moving forward. On lines 25 and 26, you can see how the income taxes were paid throughout the year, whether through withholding as an employee, estimated tax payments, or refunds carried over from the previous year. Line 33 shows the total tax payments, and lines 34 and 37 show whether they under or overpaid their tax liability. This may reveal opportunities to make changes to the withholding elections through work using Form W-4, withholding from retirement account distributions, or making estimated tax payments throughout the year. If the routing and account numbers are shown, this may indicate their primary savings or checking account, also cross-verified with which account receives their net pay on their pay statements. From the bottom of the return, I always make a note of who prepared the tax return, whether self-prepared by the taxpayer or delegated to a paid preparer. Ask them about their experience working with their preparer to determine if you can suggest a better recommendation or communicate with them directly for future planning opportunities. Keep in mind that you'll need the client's permission before reaching out to their tax preparer and discussing any confidential information. Since tax preparers look backward and tax planners look ahead, it is important to understand which professional services are actually being provided, and it's ultimately up to the taxpayer to ensure that their tax reporting is accurate.